A family of four just walked away from a mortgage pre-approval letter for $412,000. They didn't lose the house in a bidding war. They didn't get denied. They looked at the number, looked at each other, and said no. 6 weeks later, they closed on 3 acres of land and a finished 850 square foot tiny home for $81,000, paid in cash from the sale of their old house. No mortgage, no 30-year note, no bank standing between them and the deed. That family is not an outlier anymore. That's the part almost nobody talks about. Across the rural and semi-rural parts of this country right now, families with kids, families with aging, parents living under the same roof, families who make solid, ordinary incomes, are looking at an $80,000 tiny home sitting free and clear next to a $400,000 traditional house sitting under a bank's lien for 3 decades, and they're choosing the tiny home. Not because they can't afford the big house, because they ran the actual numbers, and the actual numbers don't lie. Today, I'm walking you through exactly what those numbers look like, side by side, no spin, so you can see precisely why this decision is spreading through rural America right now. And stick with me to the back half of this video, because the debt-free timeline comparison is the number that changes how most people think about their next 15 years. If you're new to this channel, we break down alternative housing with real math, not just pretty photos. Hit subscribe now, because what you're about to see applies just as much if you're planning to build as if you're just trying to figure out whether the traditional path still makes sense for your family. Let's start with the number everyone already knows, because it's the one that started this whole shift. The median price of a new single-family home in the United States crossed $412,000 in early 2026. That's the sticker price before financing costs touch it. A tiny home built to a comparable finish level, insulated, permitted, connected to real utilities, not a shed with a bed in it, is running $70,000 to $95,000 in most regions of the country. That's the headline gap everyone sees on social media. It's real, but it's also the smallest part of the story, because sticker price isn't what actually determines what a family pays over time. Financing is. Here's the part almost nobody walks you through. 5 and 7% on a 30-year fixed loan, and a standard 10% down payment. A family finances roughly $371,000. Over the life of that loan, total interest paid alone runs somewhere between $460,000 and $530,000, depending on the exact rate they lock. Read that again. The interest alone, not the principal, not the house itself, the interest cost of borrowing the money, often exceeds the entire purchase price of the home. By the time that mortgage is paid off, a family has handed the bank close to $900,000 for a house that listed at $412,000. Now put the tiny home next to that. A family building an $80,000 tiny home who doesn't have the cash sitting in the bank typically finances it through a personal loan, a construction loan, or in a growing number of cases, a USDA rural development loan designed specifically for this kind of build. Terms vary, but a $65,000 loan at 8% over 15 years. A common structure for this size of financing runs total interest of roughly $47,000 over the life of the loan. Total cost of ownership, principal and interest combined, lands around $127,000. Compare that to $900,000. That is not a small gap. That is the difference between one family's home costing 7 times more than the other family's home over the life of the debt, for a decision that on the surface just looked like square footage. And a meaningful number of families building tiny homes right now skip financing altogether. They sell an existing property, they've saved deliberately for a few years, or they build in phases and pay cash as each phase completes. When that happens, the interest number disappears entirely. The $80,000 stays $80,000. There is no version of a $412,000 traditional home where that's possible for the overwhelming majority of American families. Let's talk about what happens after the closing table, because this is where the traditional homeownership math gets genuinely uncomfortable and where most of the real cost hides. Property taxes on a $412,000 home, depending on the state, run anywhere from $4,000 to $9,000 a year. Homeowners insurance on that same home, particularly in states seeing rate increases from wildfire and storm risk, has climbed to $2,500 to $4,500 annually in a growing number of markets. And in some coastal and high-risk zones, premiums have more than doubled since 2019. Add routine maintenance. Industry estimates put annual upkeep on a traditional home at 1 to 2% of the home's value, which on a $412,000 house is $4,000 to $8,000 a year in roof repairs, HVAC servicing, plumbing issues, and the hundred small things a house that size demands. Add it up, and a traditional homeowner is looking at $10,000 to $20,000 a year in carrying costs that exist completely independent of the mortgage payment itself. A tiny home on a similar footprint of land carries a fraction of that. Property taxes on an $80,000 structure, even accounting for the land it sits on, typically land in the $800 to $2,000 range annually. Insurance for a smaller, simpler structure runs $600 to $1,200 a year in most markets. Maintenance on a smaller building with a smaller roof, smaller HVAC load, and less overall system complexity runs proportionally lower too, often under $1,500 annually for a well-built home. A family isn't just avoiding a smaller mortgage. They're avoiding an entirely different scale of ongoing financial obligation, year after year, for as long as they own the property. Here's the reason I asked you to stick around for this part specifically. Because this is the number that reframes the entire decision for most families once they actually see it laid out. It's not the sticker price. It's not even the interest. It's the debt-free timeline. A family financing that $412,000 traditional home on a standard 30-year mortgage is, by definition, 30 years away from owning their home outright, assuming no refinancing resets the clock. 30 years of a mortgage payment sitting between $2,400 and $2,900 a month at current rates, before taxes and insurance are even added on top. That's roughly 3 decades, where a meaningful percentage of that family's monthly income is obligated, non-negotiable, to a lender, regardless of what happens with their job, their health, or their local economy. A family building the $80,000 tiny home debt-free, either through cash savings or a short-term construction loan paid off in 3 to 5 years, reaches full ownership of their home in a fraction of that time. Even the family who finances the tiny home over 15 years is debt-free on their housing in half the time of the traditional mortgage, with a monthly payment, principal, and interest combined, typically landing between $560 and $650 a month, a number that's frequently lower than what many families currently pay in rent. That difference, being debt-free on housing in 5 to 15 years instead of 30, is the single biggest reason financial advisors who work with rural families are starting to bring tiny homes into the conversation as a legitimate wealth-building strategy, not just a lifestyle choice. Now let's talk about why this specifically matters for families, not just individuals, because the tiny home conversation online tends to focus on single people or couples downsizing, and that misses what's actually driving the shift in rural America. A meaningful share of families making this move aren't building one tiny home. They're building 2, sometimes 3, connected by a breezeway or placed on the same piece of land, specifically to house multiple generations. An $80,000 primary tiny home for the parents and kids, paired with a second $45,000 to $60,000 unit for grandparents, still lands well under the price of a single traditional home, while giving every generation their own private space, their own bathroom, their own door that locks. Compare that structure to the alternative most multi-generational families face in the traditional market, which is either an addition costing $80,000 to $150,000 tacked onto an existing mortgage, or aging parents moving into a spare bedroom with no privacy and no separation. The tiny home math doesn't just save money. It solves a living arrangement problem that the traditional housing market was never designed to solve in the first place. Land ownership plays into this too, and it's worth being specific about the number, because it changes the whole calculation depending on where a family is building. Rural land, 3 to 10 acres, in large parts of the Midwest, the South, and parts of the Mountain West, is still available in the $30,000 to $70,000 range depending on the county and utility access. A family selling a $350,000 to $400,000 suburban house, paying off whatever mortgage remains, and redirecting that equity into rural land, plus an $80,000 tiny home frequently walks away from the transaction with $150,000 to $200,000 in cash still in hand, money that goes into savings, into a business, into a business education, instead of into another 30 years of interest payments to a bank. I want to be honest about the other side of this, because a channel that only shows the upside isn't giving you the full picture, and you deserve the full picture before you make a decision this size for your family. Financing a tiny home is genuinely harder than financing a traditional house. Most conventional mortgage lenders won't underwrite a structure under a certain square footage, or one that isn't permanently affixed to a foundation in the way their appraisal models expect. Families going this route are more often working with credit unions, USDA, rural loans, personal loans, or paying cash, and that means more upfront legwork finding the right lender before ground ever breaks. Resale is the second honest trade-off. The buyer pool for an $80,000 tiny home on rural acreage is smaller than the buyer pool for a conventional 3-bedroom house in an established subdivision. If liquidity, being able to sell fast, if life circumstances change, is a top priority for your family, that's a real factor to weigh, not a detail to gloss over. And space is space. A family of 5 living in 850 square feet, even a well-designed 850 square feet, is a different day-to-day experience than a family of 5 in 2,400 square feet. Some families thrive in that closeness. Some families need more separation than a tiny home footprint. Even a 2-unit compound can comfortably provide. That's not a financial calculation. That's a household culture question only your family can answer honestly. So here's how I'd think about this if I were sitting across the table from you. If your priority is the fastest possible path to owning your home outright, the lowest possible ongoing carrying costs, and keeping your family's money working for you instead of working for a bank, the tiny home math is not close. It wins by a wide margin, and the gap gets wider every year mortgage rates and home prices stay where they currently sit. If your priority is maximum resale liquidity, the widest possible buyer pool if you need to move fast, and you have a family size that genuinely needs more square footage than a tiny home footprint can offer, even in a multi-unit configuration, the traditional path still has a legitimate case, even at the higher cost. What's changed in the last few years isn't that tiny homes got better. It's that the traditional path got dramatically more expensive at the exact same time interest rates made the debt attached to that path more expensive too. Those two things happening together are what's pushing ordinary families, not fringe minimalists, not people chasing a trend, toward a housing decision that would have looked radical 15 years ago and now just looks like doing the math. So here's what I want to know from you directly. If you ran these same numbers for your own family, your own land prices, your own income, which side of this comparison would you land on? Drop your state and your family size in the comments, and I'll tell you honestly how the math looks in your specific situation, because it does shift depending on where you are and how many people you're building for. If this video gave you a number you didn't have before you clicked play, that's exactly what this channel is here for. Subscribe if you want more of this. Real comparisons, real math, no hype, and I'll see you in the next one.